Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Two of the out-of-favor companies on the market right now are Verizon and AT&T. These are two of the leading telecom companies, along with T-Mobile, in the US, generating significant profits, paying great dividends. They look to be trading at reasonable valuations in the single-digit PE multiples, but the stocks can't seem to gain any traction. There are a number of reasons for that. Both of these companies have a lot of debt. They're not growing particularly quickly, but the future may be getting a little bit brighter as we put the days of high investment in new 5G equipment and buying spectrum into the rearview mirror, and we start looking forward to these companies becoming cash flow machines once again. But which one is a better stock? Which one is a better buy? The metrics actually are pretty consistent with this one. So that's what I want to get into today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And for more on great companies, check out my newsletter, Asymmetric Investing, below. I'll put a link to that in the show notes. And I just want to start with a chart here. That's one that I keep coming back to with these two companies in particular, and that's return on assets. Return on assets is really a way to judge how much money is a company making from the assets that it has on the balance sheet and is putting in the field. So a telecommunications company like Verizon, like AT&T, they're doing things like buying spectrum, putting equipment on towers, in some cases owning towers. This costs billions and billions of dollars. This is why both of these companies have a ton of debt. And then at the end of the day, they have to generate a return on those assets. So what is the return for both of them? Well, it's not particularly high. And right now for AT&T, it's actually negative, has been for a lot of the last 3 years. But you can see that one trend is consistent. Verizon generates a better return on assets than AT&T. This has been the case since 2015 and has not changed since then. So if we're just looking at these two companies, Verizon generates better return on assets. That's a great foundation for looking at these two companies. Long-term debt is another thing that I mentioned. Long-term debt at Verizon, $153 billion. For AT&T, $137 billion. So a ton of debt for both of these companies. But how much debt is there compared to EBITDA? EBITDA is earnings before interest, taxes, depreciation, and amortization. That's a proxy for how much cash flow is coming from the business before you account for things like depreciation, which is a non-cash asset. Once again, we see Verizon's leverage is a little bit better than AT&T's over time. Since around 2017, Verizon's financial debt to EBITDA has been lower than AT&T's consistently. Right now, it's considerably lower, but that's because of some one-time things associated with AT&T. They're not going to be nearly this much difference in the two of these numbers in the future, but you can see that consistently, once again, Verizon is a little bit less leveraged company when you look at debt compared to how much cash flow is coming into the business. The final thing to look at, and this is where I think investors really need to start thinking about how much cash flow is coming into these businesses and how much are they allocating to dividends, because both Verizon and AT&T have very high dividend yields. But if those yields aren't sustainable, then that's not going to be a great reason to buy the stock. So here is a chart that shows free cash flow for both companies and then also dividends paid. So that's the total amount of dividends paid at each. You can see that Verizon generating about $13 billion in free cash flow, paying nearly $11 billion in dividends. So not a lot of margin there, about $2 billion in margin between that free cash flow and what's being paid out in dividend. Not a lot of ability to reduce that huge debt load that I talked about earlier. AT&T, not terribly different, but a little bit better margin, $13.6 billion in cash flow, but coming down in that payout, the dividend, $8.1 billion. So at least over the last 12 months, there has been over $5 billion more in free cash flow generated than was paid out in the form of a dividend at AT&T. On this one metric, AT&T is definitely the winner. So which one of these companies is better to own long-term? I tend to lean towards Verizon. And the biggest reason for that is if we go back to the first chart, they simply have a better return on the assets that they're putting into the ground. AT&T consistently makes poor decisions on things like acquisitions. So as a result, Verizon's just going to be able to generate a little bit better return on those assets. They're a little bit more focused company. That's why between these two, this is my pick. But I want to caveat this by saying that both of these companies really need to increase their cash flow and potentially cut their dividends to start to lower that debt load, because I think that's the biggest problem that both have going forward. They can't maintain this kind of debt load if they're going to end up refinancing debt at 6, 7, 8% interest rates. That's just going to be unsustainable. So for both companies, I want to see them pay down some of that debt, become much leaner, better cash generating companies. If they can do that, these will be phenomenal investments. But there's a lot of work to do that. The nice thing for investors is we're getting in at a good valuation, good price to earnings multiple, good dividend yield. Even if those dividend is cut in half in order to pay down debt, it would still be a solid dividend yield for long-term investors. But what do you think about AT&T versus Verizon? Let me know your pick below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.